Good afternoon, everybody. You're very welcome to the third of our 6 multi-unit developments training webinars. I'm David Rouse, multi-unit developments advisor with the Housing Agency. Thank you very much for joining us this afternoon. We will allow some time for people who are logging into the session as they are. Hopefully you'll all be familiar at this stage with our format from our previous 2 webinars, where obviously today marks the halfway stage in the program, and we hope that you're finding the sessions informative and educational and helpful to your engagement in the OMC and MUDS sector. I'm going to share my screen again and take you through some reminders. So as I mentioned, this is our 3rd session on MUD Financial Management and OMC Accounts. The 3 webinars to come are on Wednesday the 4th of August, Company Law for OMCs, Wednesday the 11th of August, the role of the Management Agent and the Property Services Regulatory Authority, and the final session is on Wednesday the 18th of August on sinking funds. And you can register for those sessions on our website. The link is provided. A reminder of the Housing Agency for those of you who may be tuning in for the first time and may not be familiar with the organisation. We are tasked with the promotion of the building of sustainable communities. The full name of the agency is the Housing and Sustainable Communities Agency. We work with the Department of Housing, Local Government and Heritage, local authorities, approved housing bodies and stakeholders in the housing sector in the furtherance of our aim. Our rough timetable for this afternoon, our presenter, who we'll hear from shortly, will start at about 20 to 1. We'll have time for Q&A at about 1:30, and we aim to wrap up at 1:45, respecting everybody's time. Last week's session on service charges and debt collection is now available to you to watch back on our YouTube channel. So if you just pop Housing Agency into the search function in YouTube, and you'll find the recordings there. As I mentioned, please register for the further webinars using the links on our webpage, housingagency.ie, where you'll also find information about certificates of attendance for the programme of webinars. We would remind you that the information we're providing today is general in nature, intended to be informative. You should contact your property or legal professional or OMC advisor for advice on the particular circumstances of your own estate. Those advisors will be able to consider the totality of queries and questions that you may have. However, we hope that today's session, and indeed the other sessions that we're delivering, will provide you with a rounded view of the sector and of the information that you as owners, directors and other stakeholders in the sector may need to know. A reminder that today's event is indeed being recorded for future use. Once again, on screen you'll see the webpage where you can register for the remaining sessions. In terms of today's session, please use the question and answer function for questions on the topic that we're discussing today, so MUD Financial Management and OMC Accounts. Questions for our presenter. If you have problems with the technology, so sound or vision, my colleagues Sarah Kennedy and Tara Doyle are here operating in the background, and please contact Sarah or Tara using the chat function, and keep your questions for our presenter to the Q&A function. A reminder, we will circulate the slides from today's session later on, and we'll also circulate a link to the recording in the coming days. Before I introduce our presenter, I've been asked by our colleagues in the Sustainable Energy Authority of Ireland, the SEAI, to publicise or advise you of an upcoming webinar in relation to intended supports for OMCs and residents of apartments in relation to the provision of electric vehicle charging infrastructure in multi-unit developments. So the SEAI are holding a webinar on Thursday, the 5th of August at 11 a.m., where they will outline information in relation to the public consultation on those supports. And you can access the SEAI's webinar for full details of that, or access the SEAI's website for full details of the webinar, and you can contact them for more information. Again, their website is seai.ie, and again, you'll have that from the slide pack. So moving on to today's presentation, which is MUD Financial Management and OMC Accounts. Our presenter is Mr. Will Townsend, partner with Cooney Carey Chartered Accountants in Dublin. Will is a fellow of Chartered Accountants Ireland and a partner in the Audit Services Department of Cooney Carey. Will leads the in-house training function with Cooney Carey and has provided training courses on OMC companies on behalf of both Chartered Accountants Ireland and ACCA Ireland. So Will is going to deliver to us information that will be of benefit to you in terms of understanding the financial statements and accounts of owners management companies, and equally the financial management of OMCs. So we'll have some rich technical content from Will, and it will put you in a position as a stakeholder in an OMC to understand the financial background to multi-unit developments in OMCs and indeed their accounts. So I'm going to stop sharing now, and I'm going to ask Will to please turn on his camera and indeed unmute. And I think Will should be able to share his slides presently as well. So over to you, Will. Thank you very much.
Thanks for that, David. Welcome everybody to this afternoon's session. As David mentioned, I'm going to cover an array of topics around MUD Financial Management and OMC accounts. The key aims of this presentation will to provide everyone with a general understanding of the financial framework in which OMCs operate, key areas to understand in a set of OMC financial statements, provide references to key accounting and auditing standards, cover some of the more complex areas in a little more detail, discuss the role of the independent auditor, and finally, financial management, key considerations for directors and members of OMCs. There's quite a lot of topics to be covered. I will generally just cover them lightly, moving on quickly, but at the end, there will be a lot of reference material that will guide you in the right direction for any topic or query you may have. The presentation outline, we're going to start with the non-commercial nature of OMCs and the financial framework. Then we're going to cover a set of OMCs financial statements. We will have a set of drafted up financial statements, and we'll cover some of your main primary statements and your director's report. We will then cover some of the financial statements in more detail, so some of the key areas that as directors or members of OMCs you should be aware of. We will then move on to the auditor's duties and reporting, and finally financial management. So firstly, non-commercial nature of OMCs. As noted by David, this is the third in the session, and some of the topics I'm going to cover today will have been covered previously or will be covered in future webinars. So where I touch on something, I might just refer to a future webinar coming up or a previous one that you can get on the Housing Agency YouTube channel. In essence, an OMC is set up to hold the legal ownership of the common area of a development, apartments, housing developments. Purpose is to manage and maintain those common areas. A key point is that they are not for-profit entities. Typically, they do not trade for gain, mutual trading bodies. Covered in the last session was service charges and debt collection. So from our side, from the financial statements point of view, OMC bills service charges to cover expected expenditure for the upcoming year. Service charges based on budget of expected costs approved by the members in advance. Sinking fund charge to cover expenditure of a non-recurring future expenditure. And sinking funds are a key area of all OMCs and will be covered in the final session of the 6th. Balancing charge or credit or roll up into the reserves of the company. I will talk about this in more detail when we look at the balance sheet of our OMC. The financial framework of an OMC is very similar to that of any other entity incorporated in Ireland. However, some of the key policies, procedures and regulations in your OMC may be the head lease agreement, the PRSA engagement letter contract, service level agreement with the property management agent, Companies Act 2014, Financial Reporting Standards, Irish and UK GAAP, and Multi-Unit Development Act 2011. Your head lease agreement. This is the primary agreement between the owner of a unit and the OMC. Primary Property Services Regulatory Authority, so the PSRA, which will be covered in the 5th session. This is where a property management agent is employed by the company and will be engaged. There should be an engagement letter contract or service level agreement between the agent and the OMC. Companies Act 2014 and FRS. So whether you are preparing the financial statements or you are reading the financial statements as a member of the OMC, those financial statements will be prepared under two key documents, Companies Act 2014 and your financial reporting standards. We will go into these in more detail, but Companies Act 14 is a key piece of legislation governing the preparation of accounts for all companies, including OMCs. Financial Reporting Standards, FRS, outlines generally accepted accounting principles, GAAP, issued by the Financial Reporting Council. Multi-Unit Development Act 2011, legislation governing OMCs, and which was covered in the 1st session of the 6th. Your OMC may be a company limited by guarantee, a limited company, or a DAC. Just to run through some of the key points about the structures of your OMC. So a company limited by guarantee. Company limited by guarantee has no share capital, but still has limited liability. It is registered under Part 18 of the Companies Act 2014. Accounts may refer to members' funds rather than shareholders' funds. You automatically become a member when you purchase your unit in the development. You're required to include the term Company Limited by Guarantee or CLG in the name of the company. OMCs include Owners Management Company, so or OMC in their name, and this is covered under a requirement of Section 14.3 of the MUD Act. You will also have the company's constitution, which are the rules and regulations set out. Your company may be a private company, has share capital and limited liability. These companies are registered under Part 2 of the Companies Act 2014. Accounts may refer to shareholders' funds rather than members' funds. Shares are attached to the unit and are transferred on the purchase of the unit by the new owners. And again, there is a company constitution in place. You can download your company constitution from the CRO. Designated Activity Company, or DACs, can have shares or be a CLG and are registered under Part 16 of the Companies Act 2014. Company constitution will detail certain regulations not covered in a limited company's constitution. You must have at least 2 directors in a DAC. Name must include designated activity company. Shares are attached to the unit and are transferred on the purchase of the unit by new owners if it's a DAC with shares, and if it's a CLG, it transfers automatically on purchase of the unit. A hybrid company, very rare, and I've only seen one in existence, is generally older incorporated company. It was a hybrid of a limited company, but also had share capital. We'll now move on to the role of property management agent. This will be covered in more detail, but just to give an outline of its impact on the financial statements and financial management of the OMC, a property manager is appointed to assist the directors in fulfilling their duties and responsibilities. Important to note that the ultimate responsibility remains with the directors. PRSA engagement letter and/or service level agreement is a key document to ensure the roles are clearly outlined and agreed. Generally assist with property management, financial management, liaise with external parties such as solicitors and auditors on behalf of the directors of the OMC. A healthy and strong working relationship between the board of directors and their property agents is important for the smooth running of the OMC. Directors' Annual Report under MUD Act 2011. It is important to define what the Directors' Annual Report under the MUD Act is compared to what the Directors' Report under Companies Act 2014. The MUD Act Annual Report is required to be issued by the directors to the members each year. Directors should be aware that this report is a separate requirement to that of the Directors' Report required by Companies Act 2014 to be included in the statutory financial statements, and we'll cover what's required in the Directors' Report under Companies Act later in the presentation. The requirements of what should be included in the MUD Annual Report are covered in Section 17 of the MUD Act and would have been covered in the first session on the 14th of July. Companies Act 2014 and Financial Reporting Standards. Company law requires an OMC to prepare a set of financial statements annually. The format of these financial statements is set out in Part 6 of the Companies Act 2014, as updated by the Companies Accounting Act 2017. The most relevant sections for OMCs would be Schedule 3, Accounting Principles, Form, Content, Entity Financial Statements. Schedule 3A, Accounting Principles, Form, and Content of a company qualifying for the Small Companies Regime, and we'll cover what the Small Companies Regime means later in the presentation. Then we have Section 352 and 353, Abridged Financial Statements. Again, we will cover what abridged financial statements are later in the presentation. These financial statements also need to comply with the disclosure requirements of the Financial Reporting Standards. I'm now going to run through some of the commonly used terms in the preparation of financial statements. If you are an auditor or you prepare financial statements on a regular basis, you will know the majority of these terms. As a director or a member, some of these terms you may have heard and are unsure of their meaning. Firstly, financial reporting standards. Financial reporting standards are a standard set of principles or rules that should be followed when preparing financial statements. They are issued by the Financial Reporting Council based in the UK, and are commonly referred to in Ireland as FRS 102. Not to be mixed up with the International Financial Reporting Standards, IFRS, issued by the International Accounting Standards Board. The vast majority, if not all, of the OMCs I have seen would be covered under FRS 102. Generally Accepted Accounting Principle, GAAP. In essence, GAAP is just another term for the principles and rules set out in financial reporting standards. So someone may refer to it as financial reporting standards, they might refer to it as FRS 102 or GAAP. Generally how it operates is IFRS, International Financial Reporting Standards, would be used by the multinationals and larger entities. FRS 102 would be used by your large and medium-sized companies in Ireland and the UK. FRS 102 Section 1A, Small Companies Regime, would be used by companies who are small enough in size, and we'll discuss the size criteria later. FRS 105, Micro Entities. Again, the vast majority of OMCs that we would deal with would work under FRS 102 Section 1A. International Standards on Auditing Ireland, known as ISAs. These are a set of rules, regulations, and guidance for auditors, how they should conduct their work, including quality control and ethical standards. Adopted by the Irish Auditing and Supervisory Authority, on licence from the FRC in the UK. True and fair view. True and fair view is a concept used in the preparation of all financial statements, but one that does not have a statutory definition. Directors are required to approve that the financial statements give a true and fair view, and this is noted in the director's responsibility statements. In basic terms, true and fair view means that the financial statements have been prepared in accordance with applicable laws and regulations. Judgments and estimates made by the directors are reasonable and prudent, and the financial statements are free from material misstatement. Accounting policies. FRS 102 Appendix 1 notes accounting policies as the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Accounting policies used are required to be noted in the financial statements. These usually appear after the primary statements. We will cover what primary statements are a little later in the presentation. Principal risks and uncertainties. Company law requirement to include details of the company's principal risks and uncertainties in the director's report. For an OMC, these could include liquidity and cash flow risk, credit risk by way of high service charge debtors, or Multi-Unit Developments Act compliance. Financial statements disclosures relate to additional information that is included in the financial statements that would not be included in the primary statements. When we talk about primary statements, we talk about the income and expenditure account, the balance sheet, the statement of changes in equity, and the cash flow statement, or the statement of cash flows. In some cases, this information will be required by generally accepted accounting principles / FRS 102 or company law. In other cases, the directors may feel that this information is important to the members of the OMC stakeholders to ensure that the accounts give a true and fair view. Examples of additional disclosures might be your accounting policies, your related party transactions note, your security note if any issued. As noted previously, the layout of financial statements is governed by company law and financial reporting standards. Key FRS 102 sections are Section 1 and 1A, Guidance on Formats and Disclosures, Section 2 on Concepts and Principles, Section 3 to 9 on Presentation of Primary Statements, and Section 10, Accounting Policies, Estimates and Errors. A copy of FRS 102 can be downloaded directly from FRC and IASA. We're now going to move on to a set of financial statements. The aim of these financial statements is to give you an idea of what should be in your financial statements. You will note that your financial statements may be prepared by an accounting package. Generally, accounting packages will have the same format, but from what I show you here may not be exactly the same as your format, but that doesn't mean that one is right and one is wrong. So starting with a set of financial statements, you will have the cover page. The key points on the cover page is to include the company registration number, the company name, so in this case it's ABC Owners Management Company CLG, the company financial year end, so in this case it's ABC Owners Management Company Limited, CLG, Directors Report and Financial Statements for the financial year ended 31st of December 2020. The second page would be a company information page. This lists such items as directors, company secretary, registered number, registered office, management agents, independent auditors, bankers and solicitors. This is where you will get the information on the appointment and resignations of directors, and in some cases, if a solicitor has not been appointed, this will not be included. We move now on to the first key report in a set of financial statements, and this is your director's report. If you are a director of an OMC, it is key that you understand what is required to go in to your director's report. What I've done here is I've laid out some of the key headers that you will see in your director's report and give you a little information on what you could include or be required to include. So the first key point would be your principal activity. Notes the principal activity involved in the management of ABC OMC. Business review, overview of the activity for the year. Principal risks and uncertainties, notes the main risks and uncertainties for that company as previously discussed. Results and dividends, provide details of surplus, deficit and if any dividends declared. Directors and secretaries' interests are required to be noted under company law, as is any political contributions made during the year. It is required to note where the accounting records of the company are maintained, details of any major future developments. If your financial statements are audited, a statement on the relevant audit information is required. Post-balance sheet events. In many cases, there may be no post-balance sheet events to declare, but for example, in 2019 accounts, many of the accounts included a note relating to COVID-19 as a post-balance sheet event. Your auditors are required to be named and whether they are going to continue in office, and then your director's report will be signed and dated by the directors. Director's responsibility statement. There is a prescribed format under company law. It details the various responsibilities of the directors. Important again that as a director you understand these fully. This can be a separate statement or can be included in the body of your director's report. Then we move on to the third key statement within your financial statements, the auditor's report. The various headings as required by IASA guidance. On the right-hand side of the slide, you will see a document prepared by IASA, the Irish Auditing and Accounting Supervisory Authority, and they will set out examples of audit reports. The headings included in an audit report is the opinion of the auditor, the basis for that opinion, conclusions relating to going concern, emphasis of matter, if deemed required, other information, opinions on other matters prescribed by the Companies Act 2014, matters in which we are required to report by exception, respective responsibilities of the directors and auditors. Again, this is a key one if you are a director to ensure you read and understand. The purpose of the auditor's work and to whom they owe their responsibility, and then the audit report will be signed and dated by the statutory auditor. We now have an example of the first primary statement, the income and expenditure account. So our company, ABC Owners Management Company, the accounts are for the 31st of December 2020. So what we have here is a general format of your income and expenditure account. This statement is referred to as an income and expenditure account rather than a profit and loss, as the company is not trading for a gain. Profit/loss for the year is referred to as surplus deficit. Covers a period of time, usually a year, and includes the income and expenditure for that period. This is accruals-based accounting and is a topic we will cover later. Statement of comprehensive income can include a single statement of comprehensive income and profit and loss account. For OMCs, this statement can be used to show the transfer for the income and expenditure reserve to the sinking fund reserve. And this will be covered in more detail later, but this slide shows you an example. So in this case, the company had a surplus for the year of 14,900. It has a transfer to the sinking fund account of 5,000, which means the amount going to your general income and expenditure is 9,900. This will be clearly shown when we look at the statement of changes in equity. Then you've got the balance sheet of the company. The balance sheet states the assets and liabilities of the company at a period end. So while your income and expenditure account covers a period, generally a year from the start date to the end date, your balance sheet is a point in time. Format is prescribed by Company Law Schedule 3, Companies Act 2014, approved and signed by the directors. OMC balance sheet would generally be, in the case of our company, current assets. Debtors amounts falling due within 1 year, 15,000. Cash at bank in hand, 85,000. Creditors amount falling due within 1 year, 4,600, giving you net current assets of 95,400. You will note that there is notes for the debtors, cash, and creditors. So in this case, your debtors may be made up of service charge debtors, prepayments, other debtors, whereas your creditors could be trade creditors, accruals, other creditors, and your cash at bank would generally be your current account, your deposit account, and a separate sinking fund account. The bottom half of your balance sheet is made up of your capital and reserves. You will note that as a company limited by guarantee, this entity has no share capital. So your capital and reserves is made up of your sinking fund reserve and your income and expenditure reserve. Statement of changes in equity will show the share capital of any, in this case none. Will show the movements on the two reserves noted in capital and reserves. There is an option to have a single statement of income and retained earnings. But generally, where you have movements between reserves, we would advise that you put in a statement of changes in equity. In this case here, you will see that the company had surplus for the financial year, which we spotted on our income and expenditure account of 14,900, 5,000 of which was transferred across to the sinking fund reserve. So your sinking fund at the start of the year was 60,000. You transferred in an additional 5,000, leaving you with 65,000 euros sitting in your sinking fund reserve and 30,400 in your general income and expenditure, giving you a total members' funds of 95,400. Statement of cash flows. This is a summary of the cash movement from the beginning to end of the year. It's covered by Section 7 of FRS 102 and is presented under the following headings: operating activities, investing activities, financing activities. You may have noted that your OMC may not have a statement of cash flow. That is due to the fact that there is a potential exemption available under FRS 102 Section 1A. What your statement of cash flow is trying to achieve is it is trying to show you how your movement in debtors and creditors and your surplus for the year has affected your cash at the beginning to end of the year. Here's an example of the ABC Owners Management Company statement of cash flows with a corresponding note. So in this case, we've got operating surplus of 15,000. For the 2020, there was a decrease in debtors. So if your debtors decrease, that means your cash is increasing. So that's a positive. Then we have a decrease in creditors. If your creditors decrease, that means you have less cash because you've used it to pay the creditors. Notes to the financial statements. Detail included may be required by company law or FRS 102. Some of the notes included would be your general information, statement of compliance with FRS 102, the currency the accounts are prepared in, your accounting policies as previously discussed, judgments in applying accounting policies, notes to support your income and expenditure and balance sheet figures, other disclosure notes around maybe share capital, related party transaction, controlling party. And the last note is usually a note stating on what date the financial statements were approved by the members. By the directors. Detailed income and expenditure account. This is a non-statutory requirement to include these pages. These pages provide additional information for the members of the OMC. So rather than just having your income and expenditure account as per your statutory financial statements, they will break down this income into the different streams. So you might have your service charges, your sinking fund income, you might have some deposit interest, you might have some interest charged on late payments. Your expenditure would also be broken down, whereas instead of just showing one figure as it would in the statutory financial statement, your detailed income and expenditure account would break it down into different headings. All financial statements include comparative figures, as you saw in our example. Allow readers to compare the current year versus the prior year. So that's a basic set of financial statements for an OMC. As noted, you've got your key primary statements. In this case, it was your income and expenditure account, your statement of comprehensive income, your balance sheet, your statement of cash, statement of changes in equity, and your statement of cash flows. Either side of that, you've got your director's report and auditor's report, and then you've got your accounting policies and notes to the accounts. What we're going to cover now is some of the areas we've already covered in a little more detail. So we have service charge debtors and impairments. As covered in the last session, service charge debtors are a key area that require financial management for OMCs. Service charge debtors balances may include annual service charges, sinking fund charges, or in many cases once-off levy charges that have been charged out. Level of debtors outstanding can be an issue for some OMCs, and it can put a strain on cash flow. As noted in my cash flow statement, if your debtors are increasing, it means you have less cash, so your cash is tied up in your debtors. Regular review of debtors, including the aging of debtors, should be carried out by directors. This may include completeness of income, so looking at your income to ensure that your income is complete. By ensuring your income is complete, you're ensuring that your debtors are complete. An analytical review of debtors, you may look at the aging debtors days year on year. Review of correspondence with debt collection agent or solicitor. Impairments may be required to account for older or doubtful debts. Impairment should be reasonable and may be based on specific units that the directors know there is an issue with. Review of aging of overall debtors. Say, for example, you might review balances over 2 years and to decide to put through an impairment for those. Or review of current payment plans in place to ensure any units with issues are impaired. An impairment is not a write-off of a debt. You are required under FRS 102 to review your service charge debtors for impairments, and where there's an indication of impairments to make that impairment, but at no point are you forgiving that debt or writing off that debt. If a debt you had previously impaired is paid, well then you just reverse your prior year impairment. Creditors, accruals, and contingent liabilities. Creditors and accruals relate to liabilities the company owes at the year end. Accruals are generally estimates for costs that have yet to be invoiced by suppliers. In many cases, your property agent or whoever is preparing the books and records for you may have closed off their accounting package, at which point everything else is included as an accrual. Contingent liabilities are covered by Section 21 of FRS 102. Definition in the standard notes a contingent liability is either a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-recurrence of one or more uncertain future events not wholly within the company control of the entity, or a present obligation that arises from past events but is not recognized because 1, it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or 2, the amount of the obligation cannot be measured with sufficient reliability. In simple terms, a contingent liability is a potential liability that a company may have. It is not accounted for within the primary statement, so you have not made an accrual for it, but you would be required to include a note with regards to that contingent liability. If you refer to Section 21 of FRS 102, it will detail what information you are required to give on that contingent liability. Sinking funds. Sinking funds are a key area of multi-unit development financial management. MUD Act requires an annual contribution each year. It can be billed out with the annual service charge. Important to account for the annual contribution by way of transfer from the income and expenditure reserve to the sinking fund reserve. In our example earlier, you noted that there was 5,000 transferred from the income and expenditure reserve to the sinking fund reserve. We can assume that this 5,000 was the budgeted amount approved by the members in advance. Many see the transfer of cash from the current account to the separate sinking fund account as equally important. By that I mean, rather than just a simple transfer from one reserve to another, the actual cash amount is transferred from your current account bank account to your sinking fund bank account. That would ensure that your sinking fund account is held separately to the day-to-day funds of the company. A reconciliation of sinking fund movements should be maintained by the directors or the property management agent on their behalf. Where payment or costs are approved by members, it is key that the necessary transfers are carried out between the sinking fund bank account and the current account. So if we take our example earlier, if ABC OMC had agreed to 10,000 worth of costs to be taken out of the sinking fund, and those costs were incurred during our 2020 year, well, then we should have seen a transfer of 10,000 from the sinking fund back to the general income and expenditure reserve. This is a key area of financial management, as the sinking fund is becoming more and more important in a lot of OMCs. Post-balance sheet events, covered by FRS 102 section 32, referred to as events after the end of the reporting period. This relates to the period between your year end, so in the case of our company ABC, that was the 31st of December 2020, and the date that the financial statements are approved by the directors. So for example, if the accounts were approved by the directors on the 30th of June 2021, the period that this standard is referring to is that 6-month period from the 31st of December 2020 to the 30th of June 2021. Some events can be either an adjusting post-balance sheet event or a non-adjusting post-balance sheet event. By that, I mean an adjusting post-balance sheet event would require an adjustment to your primary statements, your income and expenditure, and your balance sheet. Whereas a non-adjusting post-balance sheet event would be referred to by way of note to the financial statements. Whatever your situation, it is key that if you are a director, that this is discussed with your auditor in advance or your accountant to ensure that these post-balance sheet events are accounted for correctly. Related party transaction. Disclosure of related party transaction is covered in both company law and section 33 of FRS 102. It is actually also covered by Multi-Unit Development Act, and requirements in the MUD Act annual report are also required to be disclosed. Examples of related parties for an OMC include directors, close relatives of directors, property management agent. FRS 102 will give you a definition of who is considered a related party. The key thing to understand is that some transactions are prohibited by section 239 of the Companies Act 2014. 10% of the company's relevant assets is a key figure to note if at any stage the company will be lending money to directors. This is generally not an issue in OMCs, where the majority of transactions are carried out under normal market conditions. By that I mean your director is charged service charges in line with other members and pays their service charges. Directors need to be aware of the potential pitfalls if considering entering into transactions with the company outside of these normal transactions. Disclosure of related party transactions may be required, and again, this is mirrored in section 17.2.1 of the MUD Act. Laws and regulations. There are some key laws and regulations that may be relevant to your OMC. The MUD Act 2011, which has been covered in detail. Taxation. Your OMC should be registered for corporation tax and filing an annual CT1 with revenue. There is a concession available for OMCs, but this concession is required to be applied for each year. And it is important that a response from revenue is received to ensure that the concession has been approved. VAT may be applicable if the OMC is a mixed use and has some commercial members. But if there is only non-commercial, the OMC would not be registered for VAT. An unusual one that sometimes OMCs fall into is employment law. Be mindful that contracts with service providers may pull the OMC into the net of employer-employee relationship. For example, if you have a full-time caretaker, you need to be careful that they are not falling under the remit of the employer-employee relationship. And if they are, you need to be aware of your employment law responsibilities. We noted earlier that some OMCs can avail of the small companies regime. This affects the companies in two ways. Audit exemption. Audit exemption is available for the majority of OMCs. Requirements must be met before audit exemption can be claimed. So to claim audit exemption, you must be deemed a small company. The size criteria for audit exemption is that you have a balance sheet less than 6 million, turnover less than 12 million, and employees less than 50. Your annual returns must be filed on time, and the shareholders, 10%, and one member CLG can request an audit. By that I mean, if a member of your management company writes to the registered office and requests an audit to be undertaken, it only requires one member within a CLG. If you are a company limited by shares, well then a minimum of 10% of the shareholders must request an audit. Disclosure that the company has availed of audit exemption will be required in the Statement of Directors' Responsibilities and will also be noted on your balance sheet. Separate to whether you claim audit exemption or not, there is the ability for OMCs to file abridged financial statements. Again, there's size criteria, but once the company qualifies as a small company, it can avail of the audit exemption to file abridged financial statements with Companies Registration Office rather than a full set. Abridged financial statements differ from the full financial statements in that there are no director's report requirement. Special auditor's report will be included. No income and expenditure account is required to be included. However, the notes to the financial statements will remain the same as those to the full statutory. So you always have to prepare your full statutory financial statements, but you have the option to file abridged financial statements with CRO. It's important to note that the accounts filed with CRO are publicly available. Moving on to the auditor reports. Duty to prepare a financial statement rests with the directors of the OMC. Auditor will provide an opinion as to whether the financial statements give a true and fair view of the assets, liabilities, and financial position, have been properly prepared in accordance with applicable standards, so FRS 102, and company law, Companies Act 2014. Auditor also required to conclude on going concern. Reasonable assurance that the financial statements are free from material misstatement. So the auditor only gives reasonable assurance. This is not 100% assurance that your financial statements are free from material misstatement. A very useful handbook prepared by the ODCE, Information Book 5, provides quite a bit of information on this if you want to look into auditors under Companies Act, the principal duties and powers of. As noted in the previous slide, the auditor is required to conclude on going concern. Directors will have prepared a financial statement on a going concern basis, and part of the audit work carried out by the auditor will be to assess the assumptions used in the director's assessment of going concern. This is rarely an issue for OMCs, but just to be aware of it. Work required to be carried out is covered in ISA 570. So you're required as an auditor to review projections, cash flow requirements for a period of at least 12 months from the date of signing of the accounts. The options available to the auditor is to provide an unmodified audit opinion. Where there is no material uncertainty, there is no change to the audit report. Where the auditor feels the note, which is included by the directors, is sufficient to explain why there is no material uncertainty, there is no change to the audit report. Where there is a material uncertainty, the audit report wording relating to going concern will be amended, and the directors will be required to include a note to the financial statements, usually note 2, relating to going concern, outlining what the material uncertainty is and how they have still prepared the financial statement on a going concern basis. Financial statements prepared on a non-going concern basis or breakup basis. For example, if the company was planned to liquidate in the next 12 months, your accounts will be prepared on a breakup basis. Modified audit opinion. This is where the auditor and the directors would disagree, or the auditor has been given inadequate information. The options available for the auditor here would be to qualified or an adverse opinion in relation to inadequate disclosure. So this is where they would disagree with the disclosures the directors have included to say that it is not enough information for the readers of the accounts to understand that there is no material uncertainty. An adverse opinion, disagreement on going concern. This is where the auditor and directors would disagree on the going concern concept. In many cases, it would be that the auditor would feel the company was not a going concern, whereas the directors would feel it was. Qualified or disclaimer. This is where there has been a limitation of scope imposed on the auditor, where the directors have not given the auditor the information they require or access to the individuals that they feel required to speak to form an opinion. In this case, they would qualify their audit opinion in relation to limitation of scope. Report to management those charged with governance. The auditor may feel it appropriate to provide management those charged with governance with a report noting significant deficiencies in internal control. The auditor would have uncovered these during the normal course of their audit. This is covered by ISA 260 and 265. Can also cover other matters not related to internal control, such as accounting policies and accounting estimates. These reports are used by the auditor to communicate areas of improvement that they may feel are required. It is key to note that these are significant deficiencies only, and in many cases the auditor may be able to communicate these deficiencies, if not significant, verbally to both the directors and potentially property managers if they're involved. Key area of any audit is the independence of the auditor. The statutory auditor is required to be independent. Covered in Ethical Standard for Auditors Ireland, issued by IASA. Lack of independence may compromise integrity and or objectivity of the independent auditor. They may assist with the preparation of directors' report and financial statements, but will require the directors to confirm their satisfaction with the completeness and accuracy of these financial statements. So jumping back to an earlier slide, the responsibility for the preparation of financial statements, their accuracy and completeness, solely rests with the directors. Now we're moving on to some financial management. Liquidity versus solvency. Liquidity relates to the OMC's ability to meet its short-term debt. Can it pay its debts when they fall due? Solvency is the overall review of the long-term financial position of an OMC. Important directors understand the difference and ensure both are reviewed on an ongoing basis. This is where the term cash is king comes from. A company may be solvent, but may not be liquid. If we take an example of an OMC below, we've got an OMC has high level of debtors, medium level of creditors, and low cash in bank. Overall, it may look solvent. In other words, it has a positive members' funds on its balance sheet. But can it repay its creditors when they fall due? In this case, with the low cash and the medium creditors, it is vital that debtors are recovered so that the cash is in the bank to pay the creditor when it falls due. If this is not the case, well, then the company has liquidity issues. We've noted previously of the importance of cash flow. Cash management is vital to ensure the OMC can meet its debts when they fall due. Similar to what we discussed when we reviewed the statement of cash flows earlier. Increase in debtors means there's a decrease in cash available. Increase in creditors means an increase in cash available. Good service charge debtor management is required. Forecasting of sinking fund requirements is important. This is where a once-off cost is coming down the road, and it's key that from a financial management point of view, the directors have budgeted for this and will have the cash available. Otherwise, what you will see is that a once-off levy may have to be charged to the members. Accruals versus cash accounting. Accruals accounting, you account for your income and expenditure when they occur. It is how your financial statements are prepared and why you have trade debtors, creditors, and accruals. Whereas if you prepared your accounts on a cash accounting basis, you account for your income and expenditure when you receive or pay. Under this method, there could be a large amount of receivables and payables unrecorded. Internal controls. Vital that OMC has strong internal controls to safeguard the assets and liabilities of the company. One of the responsibilities of the directors is set out in their director's responsibility statement. Controls to prevent and detect fraud and other irregularities. These internal controls may include monthly financial review meetings where cash flow, debtors and creditors are reviewed, purchase order system or system of control to ensure oversight by directors, second approval on payments where maybe payments over a certain amount are approved by 2 directors rather than 1. Strong communication between directors and between directors and their property management agent is required where one is implied. Just to conclude, the directors have ultimate responsibility for the financial well-being of an OMC, including ensuring adequate accounting records are kept, preparation and accuracy of the financial statements, safeguarding the assets of the company. There are a lot of resource materials available for the directors of OMCs to assist them in their duties, and these should be availed of. Websites that may be of importance for you would be the ODCE, Companies Registration Office, CRO, Property Services Regulatory Authority, the Housing Agency, the Companies Act, Irish Statute Book, the FRC in the UK if you want to look at FRS 102, or the Irish and Auditing and Accounting Supervisory Authority, IASA. Chartered Accountants Ireland, in conjunction with the Housing Agency, issued Owners Management Companies a concise guide for directors. This is very useful, and some of the considerations for directors of Owners Management Company are noted, and is a good source of information if you are trying to improve your internal controls. That's the presentation in full. I know I've covered a lot there. I've given you kind of reference materials that I would say go off and have a look if there's anything in particular. And I'll now hand back to David if there's any questions. Thank you for your time.
Great. Thank you very much indeed, Will. Thank you for that very comprehensive presentation. And I know we have lots of queries that have come in by email in advance and during the session as well. So we'll crack straight into it. And one of the questions that came in by email in advance, and it's reflected in some of the Q&As, is I've recently bought an apartment and attended my first AGM. As an owner of an apartment, we have 20 apartments in the block. We incur repairs and maintenance costs like all management companies, and that's reflected in our management fee each year. The question is around VAT. The questioner says, my understanding is we are VAT exempt. However, it would make sense for us to register for VAT and claim the VAT back on repair and maintenance costs. So that's the question that came in advance, and the same question has come in several different formats on the Q&A.
There's two parts to this question. So the first part is a residential OMC is not providing a VATable activity. So if you're a residential OMC with no commercial elements, you're not providing a VATable activity. So you are VAT exempt, but you don't have the option to register for VAT. In essence, even if you had the option to register for VAT, it wouldn't make sense, because with insurance being one of your key costs, you would have to charge out more in VAT. So if you register for VAT, you have to charge VAT out as well as reclaim it. So your service charges would go up, and the net effect would be you would be paying back more VAT than you could claim back. The second thing is, if you do have a commercial element, well, then there is a concession available from revenue. So if you have a couple of commercial units within your OMC, well, then those as businesses registered for VAT can apply to revenue for concession. But it's important to note that you have to apply to revenue for this concession. Once revenue approved that concession, well, then what the company would do is it would file 5 nil VAT returns for the first 5 months, and then for the last period, it would file its VAT return with the VAT on it, so your total VAT that you could have claimed back, and it then issues a VAT invoice to just the commercial members. So it doesn't affect residential members at all if you can avail of that concession.
So I think it would be important for any OMC directors or management agents to talk to their accountant or their tax advisor to make sure that the individual circumstances for their development are reflected in that.
Exactly. VAT is a hugely complex area, and OMC VAT is no different.
Absolutely. And again, we would make that point in all of our sessions, that the details and the totality of a particular case require the advice of a professional to be able to analyze all the nuances and details.
Exactly.
So someone else has asked the question, what exactly is impairment? So could you maybe just expand a little bit on the concept of impairment?
I can, and during the presentation I was like, should I explain impairment? Impairment is basically a provision. So if anyone did accounts a number of years ago, you would talk about a provision against long-term debtors. So that's where you're providing for debtors that you think may not be recoverable, for a long number of years. So what you're trying to do is get your debtors down to a point that you're reasonable that these debtors are collectible in the short to medium term. The accounting standards have changed the terms used to how you include a provision. So they don't call it a provision anymore. It's called an impairment. So an impairment is just looking at an asset and going, should we write it down? In the case of debtors, is there 1 or 2 debtors there that hasn't paid us for 1 or 2 or 10 years in some cases? And is there any, why are we carrying that as an asset? It really isn't an asset to the company. So you as a director should, in conjunction with your management agent, put a policy in place for review and impairment of debtors. Hopefully your OMC has no issues, but 1 or 2 that have issues, you need to have a policy. So this is where your accounting policy would come into play. So your accounting policy might be to review debtors over 2 years old. So in some cases, what I would see is that directors say, any debt over 2 years, we're going to impair. If the money comes in, we just reverse the impairment. An impairment is an estimate at a point in time and can change year on year. The key point is it's not a write-off and it's not a forgiveness of debt.
And I suppose from a conceptual point of view, if directors, make a judgment that they will never write off the debt and that it will inevitably be paid to the OMC, Do they need to impair it at all?
That's where your time value of money comes into play. And this is where the calculations do get complicated, and you will have to talk to your auditor or your accountant. So if you're saying, and the old argument was always, they can't sell the unit without paying the service charge, which legally in a lot of cases is the case. But if, for example, David, you had 10 years of service charges outstanding, you've lived in the block for 20 years, and you're not moving anywhere anytime soon, well then that argument of, well, we'll get paid at some stage, means that your debtors are no longer recoverable in the short term. So you have to impair them. And by impairing them, I mean using the time value of money and estimating when you expect to receive it. So that calculation would have to be discussed with your auditor.
So a question for director's judgment and discussion with their advisor, and indeed
Yes.
the property management agent as well. Another concept we have a query on is, can you give an example of a post-balance sheet event?
I can use one that we're tired of hearing, which is COVID-19. So COVID-19 would have been a key post-balance sheet event in a lot of December 2019 accounts. I think I said it in the slides. What happened there was there was an argument over when COVID actually came into Ireland, but it was deemed, say, early March. I think we went into lockdown in mid-March, just before St. Patrick's Day. So if you were doing your accounts for December 2019, you knew that your business was going to be impacted. Some of your customers may have been impacted by COVID and were not able to pay you. So had the event happened on the 29th of December 2019, you would have impaired those debtors because you now know they're not going to pay. Because that event happened after the year end in March, it's a non-adjusting post-balance sheet event, and because it happened in March 2020. In OMCs, where would I see the majority of post-balance sheet events might be fire levy. That's the one we're seeing a bit. So where you might see an investigation ongoing and something has come to light, and an EGM might be called after the year end, but before the accounts are signed off, the directors may want to just include a brief note that, an AGM to discuss the fire levy ongoing works, something along those lines.
And is the post-balance sheet event associated with the principle of true and fair view?
Yes, but there's a whole standard. It's actually a requirement of FRS 102. So it's got its own section within the standard that covers post-balance sheet events.
A question that has come in relation to, I suppose, the physical holding of funds by an OMC is whether sinking funds should be held in a separate bank account, and that's explicitly provided for in section, I think it's section 19.7 of the MUD Act.
Yes. What you will see is, and I've seen legal opinion on it, is that the MUD Act states it needs to be held in a separate account. It doesn't actually state bank account. So some people have argued that having it in a separate reserves account, as I mentioned, is enough. I would say best practice would be to have it safely in another bank account. Why I say that is it's very easy. You know yourself with your own account. If you have a savings account and your own current account, it's very easy to use the current account to pay day-to-day bills, which the sinking fund isn't meant for. So if your sinking fund money is sitting in with your current account, it could easily pay your annual insurance charge or something. So I would say best practice would be to set up a separate bank account.
A sort of related question on sinking funds that has come in. If no sinking fund is in place, would an auditor comment on this in its conclusions relating to going concern? And on a related note, will the auditor take a view on the adequacy of sinking fund balance or provision?
It's not the auditor's duty to make commentary around that area. What I would say is that the auditor may feel it appropriate to make commentary if the members have agreed to put in a certain amount and the directors have not followed what has been approved at an AGM. The auditor may feel that an emphasis of matter note might be required. With regards to going concern, and I think you'll probably cover it in your last session, David, on the sinking funds, is that it's impossible for the auditor to know what costs are coming down the road. You have to kind of hire external experts to know when the lifts are going to be replaced and all that kind of thing. So for it to impact going concern, the auditor would have to feel that the company will not be able to meet these costs when they fall due, and that would rarely happen in OMCs because levies would be charged out. I've never seen a set of OMC accounts prepared on a with a material uncertainty included. I have seen a note where, say, service charge debtors have been extremely high and cash is an issue around cash flow.
A couple of questions that are coming in that are slightly related to our company law session next week, but we'll touch on them today. So one question that come in is, do owners have the right to see detailed financial statements?
The members have to, if the directors, the members have the right to review the financial statements. So if the directors have prepared detailed financial statements, yes, the members have the right to do that. As you say, that is a company law issue. There's a decent document by the ODC called Members and Shareholders, Their Duties and Rights. And if anyone just Googles that, they'll get a copy of that from the ODC. And it actually tells you exactly what, I think what it actually says is the financial statements, so the company's financial statements, including the director's report and the auditor's report. So it doesn't actually, it doesn't actually specifically
before the members
say,
at the AGM. Yeah. Another question that come in, which might be kind of contentious: what happens if directors don't agree with the auditor's opinion in relation to inadequacies or deficiencies in the financial statements? So where directors and auditors disagree?
It happens. It does happen, depending on the level of disagreement. So, for example, if we're talking about the report to management and the auditor feels that best practice would be to do X, Y, or Z, the directors may turn around and say, well, number one, we can't put that in place, or there's reasons why we can't put it in place. So that's just a disagreement. The auditors are highlighting what they feel is best practice. The directors feel they can't implement it. So that's not an issue. That's where that would finish, in my opinion. But the auditors may then increase the testing to do in a certain area the next year because they feel a risk has been increased. Where it comes to going concern or disagreement on figures, that's where you're getting to your auditor report being qualified. And again, I've not seen an OMC auditor's report qualified. Very few audit reports get qualified, because there would have to be a substantial disagreement between the two parties.
A question that has come up in relation to, possibly refers to related party transactions, of what a controlling party might be in the context of accounts or related parties.
Well, generally, the ultimate controlling party, if you've got a company limited by shares, the ultimate controlling party is the person that holds more than 50% of the shares. They control the company. When it comes to a CLG, it comes down to voting rights. So if one person controls the majority of the voting rights, they would potentially be deemed the controlling party. You would have to look at the individual situation. You probably have to look at the members or the company constitution to see how the voting rights are passed out.
Something again we might take up at our session next week. So I'm conscious now we're coming up to 1:45, and we said, or 1:45 rather, we said we'd respect everyone's time, and I appreciate that there are lots of questions that we simply haven't had a chance to address. So we would ask everyone who wants to maybe have their question addressed to send us an email to mud@housingagency.ie. You'll see it on screen there, and I'm going to wrap things up at this stage, given our time constraints, to remind you that the slides and a recording of the session will follow by email in the coming days. Remind you that next week at 12:30 p.m. next Wednesday, the 4th of August, is our session on company law for OMCs. So I'd remind you to register for that. And again, a final reminder in relation to the SEAI's webinar on electric vehicle apartment charger grants. That session takes place on Thursday, the 5th of August. A reminder also that there are resources available on the Housing Agency's website. We'll refer to some of them in this presentation, and they may be helpful while you're waiting on our remaining sessions. So we will wrap it up. I'll say thanks to my colleagues Tara and Sarah in the background for their assistance on the tech and making sure that everything went smoothly for us. Thanks indeed to Will for his presentation and the richness and rigor of his of the information he provided. We'll wrap it up there. We'll say thank you very much for joining us, and we'll see you again same time next Wednesday, the 4th of August. Take care.